Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. Good afternoon.
Nice.
Elizabeth just said, "You're going to yell today, aren't you?" I said, "I'm not a yeller." So that's how I started. See the way I did that? Wasn't that funny? So you're laughing.
It was hilarious.
See, that's organic. You found that amusing. It is 1 o'clock on the East Coast. It's market call. It's Elizabeth Young Thomas, soon to be just E.T. like the movie.
Yeah.
I love that movie when the Jedi come and then the
joke.
Darth Vader and all those people.
And then he'll start talking about the mound. You know what I mean?
The mound,
Yeah.
when Richard Dreyfuss builds a mound in his driveway.
Yeah. This is a deep, fast money cut, by the way, because you've made this.
I've never seen Star Wars.
Yes.
I've never seen Star Wars. I've never seen, what's that show that you like?
The Game of Thrones?
No, the one with the 5 people that live in separate apartments. Bunch of jerks. No. The one, they're all a bunch of dopes. The one that worked for the Yankees.
Seinfeld. Yeah. All right. So you said it's February 27th.
I did say that.
Now after that, it's 101 on the East Coast.
102, actually.
We have Liz Thomas here.
Young Thomas.
Get your money right all in one app, Liz.
Yeah.
That would be SoFi.
I get mine right all in one app.
Interesting. Yeah, you do.
I do.
Yeah, you do. All right. What are we going to do here,
well,
guy?
Listen,
wait, by the way, a little housekeeping for a second here.
Monday.
See, so you got to tune in today, 5 o'clock. Fast Money. Yeah. This is something you guys used to do this back in the day. I think we're having a live studio audience.
That's today.
About 125 people.
You were telling me about that.
They're coming in. Mm-hmm. We're gonna have Guy is gonna be doing some fun stuff during the show. Sure. He's gonna be walking into the crowd with a mic, taking questions and stuff like
pictures.
that. That's pretty cool.
Hugging babies.
And then hopefully not. And then
is that what you're gonna wear?
No, I'm gonna change. But I know, you know what I mean? So that's today. That'll be really fun. It might be a really unique looking fast
First
money.
time CNBC's ever done something like this before with actually charged admission. And this sold out in a day and a half, Elizabeth.
Yeah.
And they had a 250 person wait list, which is remarkable. And I don't know if I'm at liberty to say, but there will be another one coming up, I believe, in June.
Well, you just said it, even if you weren't at liberty.
Yeah. No, it's cool. We're excited about it. CNBC is excited.
They are excited about it. All the muckety mucks will be there. So that's that.
Yeah.
Monday market call will be at 11 a.m. Eastern. We discussed the reasons why.
Yes.
Wednesday, though, because of Elizabeth Young Thomas, soon to be just Elizabeth Thomas, we'll be doing it at 1. I'm not trying to confuse anybody.
We'll make sure everybody knows what's going on here. And Liz is going to be taking some time off. What, about a month or so?
Yeah, after next week, I'm probably, you're not going to see me for a while, a month or so.
Yeah.
A month or so, about 4.5 times over. Yeah.
Yes, good for you.
So you're going to get to know that baby well, by the way.
Well.
And you're going to overlap with AD. We're just kind of doxing her right now. AD's having another baby.
We told people that
have we?
Pregnant.
Lots of babies in the Rich Versal Media household. Let's just hope that not one in our households here, Guy.
My age.
All right, let's do this.
Not likely.
So
true. Just saying.
We're going to spend a little time talking tech. I mean, this NVIDIA thing ended up being a real ho-hummer, I think. I think there's some stuff to kind of extrapolate from it. I think most importantly is like if you were looking for some spark to this generative AI trade, it's not happening in the form of NVIDIA. It's going to have to come from somewhere else. So we can get into that. What else are we going to do here, Guy?
And we'll talk about NVIDIA, but we're going to talk about what's on top of mind. And Elizabeth wants to talk about something we haven't discussed in a while. That's high yield, which is something on her radar screen. But, let's go to the first slide that Amanda made. Trump tariffs. We have arrows going up. And we have arrows going down because I think the market is trying to figure out, in fact, is it bullish? Is it a non-event or is it bearish? And I think that's the struggle here. The VIX suggests, though, at 19 and, each day seemingly ticking a little higher, that maybe the S&P is not as concerned as it should be, Dan.
Yeah, I mean, like we're talking about all this volatility, Liz, and a bunch of names that a lot of retail investors and a lot of institutional, folks have been really focused on because this has been the secular shift. But at the end of the day, the S&P is what? It's down 2% or so from that all-time high. And, the one thing I'll say, and, I was talking to some folks, friends of mine in the hedge fund community, and this, a lot of people, did not think things were going to be nearly as hectic as they have been over the last 5 weeks. And it's not just on trade and tariffs. There's some geopolitical. There's a lot of stuff going on. And, we talked about this, Liz, the other day, and maybe you can opine on this. It's like there was an article in Axios that was saying, well, the Trump administration, they're no longer so focused on the stock market, which they were the first time around. They're more focused on the 10-year yield and what that means. So, they think that the yield coming down is going to be better, obviously, for mortgages and a whole host of other things. Guy thinks that the yield coming down is not a great sign for the economy. So let's talk about this.
Well, and I'll get into this in the note too. I also tweeted something today, which is so not data-based, but it was a funny little chart that Mario and I found about investor emotions and just the whiplash that we've been through with tariffs just since this administration began. And I think the bigger reaction was when this was first announced, the 25% on Canada and Mexico. And now it's, okay, perhaps it's going to go into effect. I still think people aren't really taking it all that seriously. Right. And if they were taking it seriously, the market would have reacted more today to some of this news. And we don't really have much. We're flat on the S&P. We're up a little bit in the Dow. There's the graphic. This is how it's felt, right? This looks like a erratic EKG. And this is just kind of how it's going. Like, we're back, it's over. We're back, it's over. And here we are at this point where we're just sort of like, I'm not sure. I'm going to put this in mixed state now, where we've announced, okay, we're going to do it again, but it's still not happening till March 4th. So I think people are like, we've got 5 days for him to take this back, right? So here's the issue with this is that you look at what investors are supposed to do with it. How do we trade this? And I wrote a piece a few weeks ago about our biggest exposures to Canada and Mexico. And the reality is, if we put these tariffs on, number one, there are likely to be retaliatory measures, right? Which last time when this happened, when we had a trade war with China, retaliatory measures took our stock market down. So I wouldn't expect there to be a positive reaction in the market to it. And there's inflationary pressure that is likely to result from it, at least in the near term, because of the exposure that we have on an energy basis, on a consumer goods basis, on all kinds of things, not to mention layer on top of that, the labor market that could pressure things as well. So I don't think that this is good news for anybody. I think that this still is being looked at as a negotiation tactic. Markets are not, again, I said taking it seriously. I still don't think they're taking it seriously. If it goes into effect and it stays in effect, I think it's going to be rough for our economy.
It's interesting. So consumer confidence came out this week, the worst number we've seen in a couple of years, a lot worse than expected. So that was a data point. And now let's go to the next slide, because everybody inundated my inbox this morning with this right here. Everybody is way too bearish. The most bearish people have been in quite some time. This is one of the worst readings we've seen since the late 1980s, blah, blah, blah. And I think people are looking at this as sort of a counter indicator that, everybody's on one side of the boat, Dan, and that by definition suggests that the market's going to rally. Now, what I find fascinating is when it's skewed the other way, which is often, nobody wants to talk about it. And that's just sort of the dynamics of the market. But speak to this.
Yeah, I mean, listen, you tell me, what does it mean max bearish? I mean, the stock market, we just said, is 2% from its all-time highs. Carter earlier in the week told us that, 50% of the S&P 500 is down more than, I think 20% from their highs. Was that the stat or something like that? It was basically suggesting that under the surface, there's deteriorating, characteristics in the stock market. We've gone from, in the fall when we had the surprise, not the surprise, but the bigger than expected rate cut, right? There was some fear about the employment market from the Fed. And then we saw some data kind of firm up a little bit. We saw some of the inflation readings get a little softer. We saw unemployment not go meaningfully above 4%. I think the idea was with the new administration after they won that we were going to see, an economy that was starting to inflect a little bit, right? But the stock market kind of got stuck. So if you were looking at that through the lens, the economy through the lens of the stock market, it really wasn't suggesting that we were off to the races. So I look at this, I don't think this is that telling. I don't think this is the thing that you could say, oh, this is like a dead bang reason why you have to go buy the stock.
Okay,
market.
So I'm going to make an awkward sports analogy. Elizabeth will understand this. Her teams typically suck in Milwaukee. Baseball team specifically. But this is what I would compare this to. I'll use the New York Football Giants for an example. I think everybody knew last year they were going to be shitty, but everybody still went to the games knowing they were going to be shitty. It was only until they were sort of mathematically eliminated and it was crystal clear that they were miserable that people stopped going. And I think in terms of the market, everybody might be bearish, but they're still showing up to participate in the market. It's not until you get some sort of capitulation to the downside where I think that graph is important. Elizabeth, thoughts?
I think that's absolutely true. And you see investors, we call it voting with their feet, right? Nobody's really voted with their feet. I mean, people have rotated maybe out of stocks a little bit more into bonds. But I think if you see some relaxation in these geopolitical risks, you see some certainty come back into the forefront, people are going to rotate right back out of bonds into stocks and probably into those usual suspects. So we've talked about this a number of times. I've shown charts of the proportion of market return that's due to just multiple expansion versus actual fundamentals and earnings power. The momentum piece of it, the multiple expansion, is what we're giving up right now. And it'll drive itself right back up as soon as things get a little bit more calm. I think you're absolutely right. People will talk about being bearish because that's what makes sense when you look at the valuations and you look at how far we ran up so quickly, but they don't actually do much about it that stays.
That's why I think that's really interesting. So people will look at that and say, you know what, everybody's got to get back in the pool here because everybody's on one side. I think everybody might be thinking on one side of the bus. I don't think people are acting that way, Dan, which I think is an important distinction. And when you have an S&P with still within a couple percent of an all-time high, you know, we're sort of on the precipice here.
Well, so we spent most of Q4 earnings season, which started in mid-January, went through, you know, most of this past month. And everyone was just kind of looking past most of what we saw in tech. And we're waiting to get to NVIDIA, right? Like that was the thing. How many times did we say that? And we were also in the camp that, listen, we just heard basically from 4 of their major customers that make up 40% of their revenue that things, at least from the spend standpoint, were really good. So that should benefit NVIDIA. Well, we got to a point after 2 years now that their beats and their raises are literally single digit sort of things. And that's because obviously they've gone from $25 billion in revenue, I think at the end of 21 or 22, to what's supposed to be $200 billion this year, you know? So the magnitude of the beats are going to get smaller. So then the question you have to ask yourself, and we're just talking on the Fast Money call, you know, I'm, you know, read the transcripts, I'm looking at the Q&A, I'm reading some other stuff. Is like, what's happening now is that if you are a customer of these hyperscalers, if you're a buyer of these GPUs, you are focused on the total cost of ownership and the return on investment. And if you cannot get those numbers in line that make sense for basically what, you know, how you're thinking about this new technology and how you're going to deploy it, then it's going to kind of tamp down over the course of this year. So I look at what's happened. Guy, you mentioned Microsoft. Look at Google, the way that's traded. Meta is obviously still up in the air. You know, Taiwan Semi, which is a fab that makes the, you know, the chips, they have 85% market share. That's come in a bunch. I just think NVIDIA is going to be stuck in the mud here. I just don't see a lot of upward sort of, I don't know, momentum. So then the question is, what is the thing in technology that drives the train if you don't have the 10 biggest names? And I just can't come up with it right now, Liz. I mean, so you had a tweet about rotations. Maybe Amanda has that. And you just mentioned rotations. If tech's not going to work right now, and I don't mean not going to work like it's falling apart here. If it's just not going to go higher, what keeps the market here or going higher?
Well, it takes a number of other sectors. So tech was able to do this on its own single-handedly for a long time, for 2 years. And when we talk about tech, to be clear, we're also talking about some names that fall into communication, some names that fall into discretionary. We all know which ones we're mentioning, but those names were able to single-handedly keep the market propped up for a while because there's such a large proportion of the index. So you need other sectors to come in and carry the weight, but you need more than one of them at a time to do it. So the cyclicals trade, or this rotation and broadening out trade, can do it, but you need at least a couple cylinders firing together, right? Instead of just the technology cylinder. So one of the things that people had been relying on was financials that could do part of it. And I think that has been here and there pretty successful, but it's been weak over the last few weeks. So not something that we can rely on maybe as dependably. And then you need other sectors. You need things like industrials to keep up. You need even materials to keep up, healthcare. You need all of that to sort of carry its weight in order to make up for a lagging tech sector. Now, it doesn't mean that the tech sector is going to be down necessarily, but the other thing that I think is important, if we can bring that S&P chart back up, it was a longer term chart with a trend line underneath it. So something that we talk about a lot, and I read a piece about this the other day. We talk about corrections and bear markets, right? A correction being 10%, a bear market being 20%. What if we define it differently? And a bull market is any time that over a period of months, you've got higher highs and higher lows. We're still in that right here, right? So I say that because even when we have these turnarounds, even when we have these pullbacks, people freak out and they wonder if this is the beginning of a bear market. Relax until that actually happens, right? Because right now, this is still very clearly a bull market.
Love it. I love the relaxed part. Do I look relaxed to you? I'm typically relaxed. Yesterday, Dan brought forth a slide that said this Trump 2.0 administration is now more focused on interest rates than the stock market, which I thought was really interesting. So let's throw up an interest rate chart. And, we got down, I think, 422 or so. I think rates are bouncing a little bit today-ish. We're right at the moving average. I guess all my awkward way of saying to you, what do you think is going to happen to rates here?
Well, okay. So actually, I'm going to skip ahead and I want to pull up one chart from my note. It's got all the dots on it. You know what I'm talking about, Amanda. So here's where I think maybe the error of their ways could be if we're focused more on interest rates. Hang with me here to explain this. So we're talking about the correlation between basically the 10-year yield and stocks. When the market was focused on inflation, you had inflation fears pushing yields higher. This was happening towards the end of last year through about mid-January. The 10-year yield was rising because inflation was either not moving down or had started moving back up. The takeaway there was that the market was taking the 10-year yield up because, okay, inflation is going to be stickier, but that must mean that growth is okay. The consumer's still spending. We're absorbing it just fine. Stocks did struggle during that period, but the reason for the rise in the 10-year was because of inflation staying warmer, we'll call it. Now, the reason for movement in the 10-year is different. You've got since January 20th, the 10-year is falling. The 10-year is not falling because inflation fears have disappeared. The 10-year is falling because people started to worry about growth. People started to worry about what might happen to the consumer. We got some earnings reports about big consumer companies that were a little bit less optimistic for the rest of the year. So now you've got the 10-year falling, stocks still struggling. So this is where if the Trump administration is saying, we want the 10-year to come down because that's going to free up some of the mortgage market, you need it to come down a lot, first of all, to free up the mortgage market. Second of all, if the 10-year is coming down because of growth fears, stocks are still going to fall with it.
I agree with that. And it's one of those things, if they do come down rates in a meaningful way, like what's going to be the driver for that? It's not going to be for any good reasons necessarily. And to your point, and you had this conversation with Tim Seymour on the desk, I think, the other night.
He was in the commercial break.
In the commercial break.
No, we were saying that because, you saw the 10-year yield come in from 480 to 430, and I was looking at the 30-year mortgage rate over the last, period in which that yield move happened, and it moved like 10 basis points. You know what I mean? So, the point is that even if the Fed, and Guy, you've said this all along, let's just say they come out and they cut 25 basis points to the Fed funds, which is now 4.5%. That doesn't mean anything what the 10-year yield's going to do, and that's what is more tied to mortgages. And then the other thing is, if you have a PCE, which is what the most
the favored indicator, or was it the favored
reading of the Fed?
Yeah. So
a guy gets Guy tuned up. So let's just say that's just a little bit hot. Just a little bit hot.
I think listen, I'll put it out on the line and say it's going to be a little bit hot. Yeah, that's just me.
So there's no chance they're cutting rates anytime soon. You know what I mean?
And they've made that clear. And the markets, when's the next cut they're pricing in? I think maybe June, if not September, right, Elizabeth?
September.
So it just seems like, we said it yesterday. Doug Cass calls it slugflation, which I like, just a sluggish economy. And then you have sticky inflation. And it really feels like that's where we are. And again, relax, as you just said, you know what I mean? But what do you like, Liz, in the last 2 weeks, it feels like we're starting to hear the word recession in a way that we haven't heard, I want to say, since early 24, late 23. Does that make some sense?
Just to correct ourselves, the first cut is now priced in July. And we've got 2 cuts priced in for the year now again. Now, remember, that moves very quickly. That can change overnight. But anyway, so I think you're hearing the word recession because of some of what I just talked about. Growth fears are here, right? People are worried about economic growth, worried about tariffs pressuring growth, worried about consumers slowing their spending, worried about company earnings in those sectors. So then, of course, we're going to start talking about a recession because the largest part of our GDP is consumer spending. It's been really the only thing that's holding it up. So if that gives way, then you've got concerns. I think we're still far off from that. If we're defining a recession as 2 consecutive quarters of negative GDP growth, we're still expected to be showing somewhere between let's call it 1.5% and 2.5% growth for the foreseeable future. So things would have to go awry. I think the other thing is, yes, we can talk about a recession. There's always some chance of a recession. If some of these policies start to pressure the stock market enough, start to pressure the economy enough, the Fed will turn dovish. They will have to. And I think that would bring some of it back out of the doldrums. Now, that presents other risks, right? That sends inflation probably back up. But I think they would turn dovish pretty quickly if the economy started to suffer.
Right. And this goes back to what we started the conversation about, this tariffs on, off, March 4th, April 2nd. I mean, whatever. I just don't see. We just said, okay, they're most focused on the 10-year. That's bullshit. Like, let's be honest. Okay. Like, if the stock market was down 10%, you know what I mean?
Right,
fairly quickly,
right. That's right.
The Truth Social would be lighting up like a Christmas tree, and the blame would be all around. So I guess the point is like, we're going to get to April or what is March 4th, which is what, Wednesday or something like that. And they're going to push them off. They're going to kick the can down the road. We've seen this. Like, didn't this happen all of 17 and 18? The fact that we're talking about it right now. But the one thing I'll just say is it's putting traders, it's putting investors, it's putting folks, market participants in general on edge, which just doesn't need to be happening. Because what sort of concessions are they going to literally extract in the next few days from the Europeans? I think if anything, they're getting emboldened. I think the Canadians are getting emboldened. No one likes to be bullied. And you know what? Like, at the end of the day, Europe is kind of, their economy's coming out of what they've been in, and we came out of much earlier. So again, I'm not wishing for anybody to come at the U.S. in a hard way. It's just like, let's go about it in a smarter fashion.
Okay, this is a public service announcement.
Yeah.
So I'm going to look into the camera now. If somebody is bullying you, drop him or her.
No, you know what you do?
No, I'm telling you what
punch
you do.
him right in the face.
Yeah, that's
kick
exactly
him right in the nuts.
And that's it.
That's it. I told my kids that a long time ago.
So that ends it.
It does end
I was in 3rd grade.
Uh-oh.
Okay.
Is this the lunchbox story?
Well, you know this story.
I don't know this story.
You want me to tell you the story?
You know what?
What?
Last time you told this story, people like, holy shit, they saw like another version of a guy.
True. It's all true.
Yeah.
I had my little button-down white shirt on,
Yeah.
and I had my lunchbox.
Let's give the G-rated version because it's for the kids are watching.
There was a kid on the bus that used to really break my balls constantly.
Mm-hmm.
And one day he just pushed it too far. John De Silva. And if you're watching, John, how you doing? I think he was in 5th grade, and I was like 8 years old, maybe. And finally I had it. So I cracked him over the head with my lunchbox. I mean,
one of those metal
ones, and it has the thermos in it.
Wait, what was on? Do you remember? Like, was it
probably like a Charlie Brown?
Yeah,
maybe if I had to guess.
Snoopy
I don't remember
like
exactly.
All right, by the way,
but I dented it, so it ruined the damn thing.
All right, but
I went home and my shirt, the buttons, because we sort of then.
Yeah.
My mother asked what happened. And I told her what happened.
She was like, "Good little guy."
She made me walk down to the end of the street and apologize. Never forget that.
Yeah. So, by the way, all right, the reason why I thought that. Okay.
Anyway, don't allow yourself to be bullied. That's it. I mean, just crack somebody because that ends that shit. Because then you can pussyfoot around and discuss it. Oh, let's have a talk about it. Nope. We're not talking about it. That's the only way you get shit done.
Yeah.
I don't know how this came about. By the way, going back to the market, I think part of the belief of the administration, if rates were to go lower, the market would
bullying.
Market would take care of itself with lower rates. I think that's a flawed. I think that's a flawed reasoning, in my opinion. Back to you.
Yeah, I mean, listen, again, we're talking with a market that's actually trading pretty well. If you've enjoyed a lot of the gains over the last 2 years, 25% a year for the last 2 years, you're probably not panicking. And then the other thing I'll just say, and we've been saying it again and again and again, with all this policy stuff, they're throwing stuff out there. It's probably going to like rest at the base case scenario. Maybe the China tariffs stick, and you tell me, is it more important that we don't have 25% tariffs on Mexico and Canada than another 10% on China? I'd probably take the 10% added on China is probably much better than our trading partners, both here and over in Europe. Yeah. You agree with that?
So if Canada had a lunchbox, we'd be in trouble. Is what
maybe
saying.
They should get one. Okay, maybe they should get one. And that's not like I'm waving the Canadian flag here. I just don't like anybody getting bullied. I think it's uncool.
Yeah.
But what I do think is cool is the fact that you're focused on high yield bonds. So let's talk about this slide. Bill thought that was funny.
The other thing I want to bring up is I think there are people who are panicking because if you just look at year-to-date sector returns, the worst sectors are consumer discretionary and tech. Third worst is communication. So if you're overweight, what do we call it? Not the elite eight.
The fateful eight.
The fateful eight. Yeah. If you're overweight, it was the Mag 7 towards the end of the year. Now it's the fateful eight. if you have a lot of your portfolio assets in those names, you probably are panicking.
All right. So you know who's kind of panicking is small businesses. So if we've seen like some of that small business sentiment, if we see how poorly the Russell 2000 acts, we've seen the guy mentioned the consumer confidence, like large ticket items that you're seeing a pullback in that. So it does seem like something, and especially this is another thing about these headlines and the uncertainty. When people open the newspaper or they watch the TV or they look at the internet, and every day you hear about government workers being fired, that doesn't make you feel good. That's a group in the employment market that you think is about as steady as she goes, right? For the most part, you don't hear about a lot of government job cuts. I think that sort of stuff is going to seep its way into consumer confidence if it hasn't already.
Yeah, I mean, I think it probably has a little bit. I also do think, though, that people hear about it. Maybe they don't necessarily get the warm and fuzzies about it, but it's far enough removed, right, for most of America. It's something that is going to affect Washington, D.C. and not going to affect Wichita, Kansas as much, right? And it was, I think, probably similar to what happened in Silicon Valley. We had a bunch of job cuts in Silicon Valley a couple years ago.
Did you hear that? Silicon Valley.
Silicon.
She said con.
No, she said cones.
So whatever.
I heard her say
silicone is something different than silicon.
Silicon Valley.
Yeah.
In tech.
Silicon goes into
tech
wait,
Valley.
hold on. You ready for this? Silicon
Wafers.
goes into consumer electronics.
Wafers and
silicone goes into what?
How do you know? Apparently people
goes into a lot of things, cooking utensils.
Right.
Anyway,
and
there were a lot of layoffs in tech companies a couple years ago. And I think most of us thought it would shake sentiment more than it did. But because many people were far removed from it, I think some of this government stuff will have the same effect. But Guy tried to transition into high yield before.
Unsuccessfully.
I'm going to do it now just in a clunky way. Let's talk about high yield for a second. So my note this week, which dropped this morning, is called Tide Change. And I wanted to focus on the momentum shift that happened in the market. There are a lot of single stocks that are down quite a bit, and they were the ones that did really well last year. So we've had this really big flip-flop. One of the flip-flops is the chart that you're looking at here. You've got high yield bond spreads. Look all the way back to August of 2024. Now that was, we remember the Japanese yen crisis. So you saw a spike in spreads there, but that's really all it was a spike. It came back down very quickly. And then they've been on this slow grind tighter up until very recently. And you see the rise in spread. So basically this is telling you high yield bonds sold off. Okay. This is the spread over the 10-year treasury. High yield has been something that has been a head scratcher for many market participants for a while, because even in times of some of the equity volatility or times when we were worried about credit or expecting credit to show cracks before equities, high yield didn't really budge. And again, this could just be a head fake, but it's important to watch because a lot of times the bond market reacts before the equity market does. High yield is very highly correlated to moves in equity markets. So this makes sense given the momentum unwind that we've seen. And it is, I think, something that serves as a warning sign.
I love that. And I think you're smart to be pointing it out. If you want to throw Amanda real quick or Jacob an HYG chart, not that I'm suggesting you trade this, but if you look, we just traded up the levels we last saw, oddly enough, in September of last year, August, September of last year. So, you know, the HYG sort of backs up what Elizabeth is saying. So this is going to get pretty interesting here. I think you absolutely have to watch it. JNK is something else that people watch. I think that's more interest rate sensitive, but I agree with Liz. You know, the fact that credit never really deteriorated in an environment where I thought it could a number of times, Dan, is really interesting.
Yeah, I mean, that also speaks to the fact that who's panicking, right? We've looked at high yield. It hasn't been a problem for a very long time. And so, again, you know, like we could sit here and bang on, you know, the economy is going to do this and unemployment's going to go here. And I don't mean to sound glib about this, you know what I mean? And the stock market's going to correct, that sort of thing. But to Liz's point, a series of higher lows and higher highs, you know, could suggest that we're still in a bull market.
What do you think about the relationship that we have?
I think it's a good relationship.
And the one that you and Dan share?
Also good.
Does it matter to you?
It does.
Amanda, please.
Oh, my goodness.
So there's a section in my note called Relationships Matter.
Oh, my God.
Instead of talking about relationship problems, which I usually talk about, this time I'm talking about relationships mattering because they do. So what we're looking at here, and this is similar to the message that we're sending in that dot chart that I showed before, is basically the Russell 1000 growth, the Russell 1000 value, and the 10-year yield. The main takeaway here is that even over the period where the 10-year yield had stayed elevated, let's call it above 4% for the majority of the last 18 months. We've had a few dips in there, but it knocked on 5%. It got back up to 480, got back up to 475. So it's been higher than we're used to for a long time. And stocks did just fine. In fact, growth stocks did better than value stocks over that period, which is counterintuitive. Things changed in the last couple of weeks. The 10-year yield came down. Growth stocks came down harder than value stocks. Again, that's because the driver of why yields are falling changed. So this is something to watch. And it's not a relationship problem per se, but it is a shift in the relationship. It's a shift in the dynamic. And as an investor, this should serve as a warning if you have not diversified your portfolio away from some of those growth stocks and given yourself an opportunity to take part in any sort of rally that happens in value stocks or even any sort of rally that happens in treasuries. You have to make sure that you have exposure. I think we've gotten too used to, as investors, looking at our portfolios over the last 2 years and seeing green across the board. It's not all supposed to be green every day. If you have a diversified portfolio, some of it's going to be red, and that's how it's going to work. You have to give yourself the chance to not be caught in a mess that could happen like this.
It's interesting. I mean, you're talking about 10-year yields, basically generic government 10 years, which obviously are falling, and it stands to reason that the economically sensitive, is that blue
Light
and red,
blue.
teal,
Blue and magenta.
blue and magenta. I mean, it's that those relationships will remain intact. So what does that mean? If yields are falling, they're falling in this case because maybe there's slowdown in growth, Dan. And if there's a slowdown in growth, as we have said 100 times, most economically sensitive names are not going to be impervious.
Yeah. And listen, so the slowdown in growth, acceleration in growth, I just have a hard time. Again, I am not so bearish here. I'm not so bearish on the economy. I'm not so bearish on the stock market. I'm fairly neutral. I came in that way this year. I just, at some point, there would have to be a major misstep on the economic policy front. And again, we will not know that for a couple of months to really, in my opinion, and a sustained mistake. Do you know what I mean? Where they don't back down to get the economy weakening in a meaningful fashion. That being said, AI and the CapEx cycle and everything, that might have been the thing that has really helped the economy over the last 2 years. I'm not sure it helps it much more from here. So the question is, what else emerges? Is it China and their economy bottoms out and they start doing all this stimulus and then, their deflationary issues stop there? And again, we're dealing with inflationary issues. They're dealing with the opposite of that, deflationary. And you could make the argument that that's much worse potentially for their economy than, sticky inflation over here. So I don't see it. I just look around. I don't know what the next thing that causes the economy to inflect and therefore the market.
I mean, I think it would have to be a policy mistake, whether fiscal or monetary, or some sort of exogenous shock, which you can never invest just trying to avoid exogenous shocks. I think the main point here is that this pullback has been sentiment based. It's been a lot of give back in that momentum. And that doesn't mean that it's going to last or that it's going to be very deep or that it's the beginning of a recession, but it's more about psychology than it is about what's actually happening with the fundamentals. Because frankly, the fundamentals still haven't changed that much. So even the weak spots that we knew there were before remain. And just because NVIDIA didn't knock the cover off the ball doesn't really change the fundamental story that much. And I finished my note with a very simple line: don't panic, diversify, right? Because when you panic, the other thing is when the market is going down, panic selling locks in the fact that the market has just gone down in your portfolio. You've given back a bunch of the gains. You just locked in the fact that you gave back a bunch of those gains. So the panic selling is what feeds on itself until you get the full flush, and then the flush is done and you move in the other direction.
It's always good to
as soon as that came out of my mouth, I was like,
listen,
no.
It's always good to get the full flush. Sometimes it requires multiple. That's really depending on what you ate the night before. You brought forth also this total returns. And you have that little smile on your face. You can't help yourself. This is interesting because this is the first 2 months of the year. This speaks to maybe some of the concerns out there. Communications, which has been on fire, and then consumer discretionary, which is also sort of now lagging.
Yeah.
Talk about this.
Yeah, I mean, this is even if you just back up and you're not looking at what the words on the bottom of this chart say, it's pretty much a full reversal, right? Everything that's blue and high to the left is now on the other side of the chart. So this is January 1st to February 14th, so the first 6 weeks or so of the year versus the rest of February. This is just, again, highlighting the reversal we've seen, the rotation we've seen, and this is why diversification is important. And when we've talked about, I've used this quote before, big tree fall hard.
I love that.
There's another quote that is a market quote. What the market giveth, the market taketh away. Okay. So we've talked about so many of these names that have seen astronomical returns. Those are the first ones to go, not just because of retail investors, even though I know that's been the story over the last few days that retail has gotten jittery. They probably have, but also if retail gets jittery, you have to think about some of those big institutional investors. If they're getting redemption requests from a managed portfolio, they have to meet those redemption requests. The easiest things to sell are the biggest, most liquid ones that have gains, which are the stocks that we're seeing here that have pullbacks in the last couple of weeks. So it's not just retail, it's institutional, it's everybody at the same time, and it's positioning. Now, that doesn't mean, again, that something is terribly wrong, but positioning can have a really big effect on markets.
By the way, when you stand over the son of a bitch bully after you drop him,
still there. He can't get
you can say that you can say big tree fall hard the same way Brad Cooper did to Vince Vaughn. Although in that case, Brad Cooper was the bully, but
that was Wedding Crashers.
Sure it was.
Wait, so
no, I can't get around
what's
that.
The infamous, it's one of the best photographs ever done of Muhammad Ali standing over Sonny Liston.
By the way, that was the anniversary of that fight.
Maybe
I think
Jacob
it took place in Maine, if I'm not mistaken.
Really?
If I'm not mistaken.
Why would that be in
Not
Maine?
sure. A lot of people think Liston took a dive.
Really?
Because he had a gambling problem, he had a drug problem. They think he was sort of in bed with the mob and he took a dive. If you look at that punch, a lot of people said it was a phantom punch that knocked Liston down. Ali says he hit him cold. Obviously now Muhammad Ali has passed away, but when he talked about it, he would say, "No, I really did get him." But that's a famous picture, and I think it's Leifer is the gentleman's name that took the picture. Jacob, tell me if I'm wrong. Leifer.
I want to know where it was.
And that happened in like a second. If you watch this in real speed, like he wasn't standing there. That took place. He captured that image.
Yeah.
Beautiful.
It's amazing.
Leifer, I think the guy's name.
I don't know. Are you into boxing? I'm not into boxing, but I like good. I like picture. Yeah, it was beautiful. I like good documentaries. Have you ever seen that When We Were Kings?
Yes,
of
course.
Man, this is like an amazing
Ali
doc.
Boom.
Ali Boumbaye.
Boumbaye.
Yeah. So it was George Foreman. It was in Zaire. It was 1976, I think it was.
Rumble in the Jungle.
Yeah.
Great
movie.
Ali Liston.
Oh, okay.
February 20. Oh, it was in Miami Beach, Florida.
Maine sounded odd.
Yeah. Oh, no. Their second fight was on May 25th, 1965. In Lewiston, Maine. That's where that picture was taken. So I was right.
Of course you were. You're always right.
And the picture was taken by why can't I find the name? I think it's Leifer is the gentleman's name. Amanda or Jacob can help me. With that said, I sent Jacob a tweet that I got. Jacob, I don't know if you can put this tweet up. Hopefully Jacob saw it and can put it up.
Okay.
One of our viewers, Mike, who's with us all the time. Guy Adami, your lunchbox story is akin to Vito Corleone taking down Don Fanucci. That's Godfather 2.
Yeah.
That's Robert De Niro.
Yeah.
Because Fanucci is bullying
Fanucci
the whole.
Was kind of excited to see him when he opened the door.
He was, because he admired the kid.
Yeah.
But little did he know that De Niro had other plans for him.
Yeah.
Shot the son of a bitch. And what people don't realize in that scene, De Niro wraps a towel around the gun and he shoots him. That towel caught on fire. They didn't know that was going to happen. Yeah. So that was a real De Niro. That was like him just like
then he goes up on the roof and he starts pulling the gun apart, throwing it in there, and whatever.
You're not dumb. And then he wound up on the porch with his kids waving American flags.
Here's something. If you're in the chat right now, so Liz just said she's taking 4 months off. Let's come up with some ideas.
Neil Leifer. There you go. I was right.
Some series that she should watch. You know what I mean?
Oh, yeah. Give me some binge-worthy
Let's give her
stuff.
some binge watching ideas. It could be movies. It could be movie series, like the John Wick series. You could watch all 4 of those. You could
movies. I have trouble sitting still.
Oh, really? Okay.
I watch movies in 2
Have you
months.
seen Peaky Blinders?
No.
Oh my goodness. That's one of the best. Guy, you would love this show. You would absolutely love it. It's like Birmingham, England, circa 1920.
They're like soccer fans.
No, it's like The Sopranos. it's you would love it. It's amazing.
No, it's not. No, don't compare it to The Sopranos.
Have you guys ever seen The English Patient?
Ugh,
that sounds like Is that a
Well,
tearjerker?
That was like a meme back
it's
in
not-
like
it's
30
not a
years ago.
tearjerker. My point with movies is that even if I have seen a movie, I'll tell you I haven't, and then about 15 minutes into it, I'll be like,
You'll
"Oh,
remember.
I've
I saw this.
I just did that.
All
to
right,
Greg
let's
last
get
week.
some ideas for Liz. She's gonna have
Yeah,
some time when
give me
she's
some
not
ideas.
burping babies and changing diapers in the lake. You know what I mean?
It's not plural.
Babies.
She's not
One.
having.
You know what? In my
I mean, I'd know
household,
by
it was
now.
plural when I was growing up. My mom had
Well,
two
you had
sets
two
of twins.
sets of twins.
We got a couple more things.
Call of the day.
Let's this will be a good one for Liz. This is Keith Barrett Woods, and these guys they're like the axe in
banking,
and,
they
and
are.
stuff like that. So they downgraded guys' former employer Goldman Sachs to market perform from outperform. They cut their target from 690 to 660. FactSet average is 665. That's fine. They're coming in line here. They don't do anything to estimates. Let's pull up a little chart of Goldman Sachs. I mean, this is a name that, a lot of folks got excited about. So look at that gap in early November. Massive gap. Look at that. Okay. What was that? Okay. The IPO calendar was going to come back. M&A was going to come back, that sort of thing. It almost filled in that gap a month and a half later, and then it started to break out. I think that your point about a bull market being intact, what is the thing? A series of higher lows and higher highs.
And higher lows.
What are you doing with that one, guy? What are you doing with that chart?
That channel's intact without question. We've been in an uptrend since October of 2023. Even if you wanted to broaden that out, that has not been violated. Again, as you just said, series of higher highs, higher lows. It all makes sense. They lowered their price target, but 672 is the all-time high. They lowered it to 660. This is just sort of trimming around the edges. You don't run too far away from Goldman Sachs here. You get concerned if you get a violation of that lower channel, which is probably 600 or so, and then you say, maybe something's going on. Maybe we trade down to the moving average. But right now, I don't think there's anything to be all that worried about.
Liz, you looked at high yield. We looked at, we looked at the 10-year. We have a sense of what the Fed's going to do for the rest of the year. Bank stocks, they went up when yields were going up. They went down, up when yields were going down. How are you thinking about them right here? Do you need to see an IPO calendar and M&A activity? Do you need to see that sort of stuff pick up? Because those banks all had really good trading results for the most part over the last couple of quarters or so.
Yeah, they did have good results. Right. And that's the way we kick off earnings season. So we look to the banks to set the tone for the rest of earnings season. And I think they've held their own. They've done a good job at setting a decent tone for all of the earnings seasons that I can remember for a while. The financial sector itself has suffered over the last week, over the last month, over the last 3 months or so. And it's mostly been dragged down by the banks. It's been held up slightly by insurance. And then you've got financial services companies in there, which some of these fall into. So I think the big ones, Goldman in particular, and some of the other ones that have big M&A activity groups, so things like investment banking, the ones that are reliant on that type of activity, the capital markets activity, are going to be sort of sideways here until we have more clarity. The thing that we've talked about, I think last week we talked about this, the fact that the Trump administration is going to keep some of the M&A standards in place from the Biden administration was a disappointment, I think, to some of those stocks in the market. But I don't think it really hurts the small and mid.
Also, though, they were going to keep in place some of these DOJ and FTC investigations of big cap tech. And one of the things that's important about, because big cap tech has not been making acquisitions as they normally do because of all that sort of stuff. So there's a bunch of headwinds. I mean, those were the sort of pro-growthy sort of things that a lot of people got excited about. So to me, it's another thing. This would be an own goal on their part relative to what they were talking about during the campaign.
Yeah. Well, and the last thing I'll say about this is some of these financials companies are reliant on brokerage activity, right? Markets activity. So when the market's down, brokerage fees are going to be down. You're going to have a little bit of a suffering there. Plus, add on top of that, if you're reliant on investment banking revenue, IPO activity, these companies are going to suffer or at least go sideways until we have more clarity and see some action.
We plan on having Elizabeth next Wednesday. We said that. But
that's the plan.
Mother Nature might have her own plans.
She might.
So there's a chance you have a baby from here to then. And if that's the case, we will not be seeing you.
That's true.
With that said, we adore you. We adore your family. And we're going to adore this baby. Everybody's going to miss you. But this baby is so lucky to have you as a mom. I mean that sincerely.
I'll tell him.
You're made to be a mom. So again, hopefully we see you Wednesday and we'll have the same conversation.
We'll see her
but if not, I just wanted to make sure we got that out there.
Thank you very much. I'm very excited. I'm full term as of today. So he could come anytime. Anytime.
And then we'll see Elizabeth probably in like September, perhaps, Dan.
Hopefully sooner than that. We
think probably
just
a
guys,
little
the
too
two
many.
of us. These people are gonna get bored of
People
us
love
really
it.
quickly here.
People-
I'm gonna tell you that right now.
People, they say all the time when
Yeah.
we're out and about, they love Elizabeth.
Liz did tell us though also that she's not going to disconnect totally from the markets. You're going to kind of keep an eye. You're going to keep one eye on everything.
I'm
Yeah.
gonna watch, but I'm not gonna like do phoners.
So by the way, Amanda just put some of this stuff in the chat. Here are some of the so Ozarks. I agree with that. That's amazing. Sopranos,
I've seen
obviously.
most of that.
Severance, I think it's boring. What? Silo is great.
Look at what Jacob just texted.
The halftime report.
Halftime report. I've seen a lot of those, Jacob. Thank you.
That's funny.
Yeah.
I wouldn't watch that. You could say to me, you could either watch a halftime report or we get a hammer and nails and drive them into your nuts. I'd be like, where's the hammer and nails?
I missed most of that. I was reading my
I'm
text.
just
on that
saying.
front.
Okay. Yeah, I've seen most of Ozark.
Bill, right?
I'll-
Ozarks.
I'll
How did you
take
not
some-
finish it? It's amazing.
I don't know.
Do you like
I heard-
crime stuff or no?
Yeah.
Oh, The Wire is amazing. It's a must.
I have heard that.
Oh, it's
Okay.
amazing.
Start with the Sopranos and work your way out to all these other things.
Okay.
Sopranos will give you a good understanding of life.
I think I've seen the first couple seasons of this.
Okay. It's not, you know what? I don't think there's anything wrong with going back and watching Homeland. Genius. Brilliant show.
I've seen
Dan's
a lot
not a
of
fan.
I
that.
know I like it.
Yeah.
I would have liked that thread. I like the they just ended it with the ginger, the guy from Billions.
Yeah.
Mhm.
Like after the first
Like,
season.
he got no, he was like 3 seasons when they whacked. They hung him from
No, I think at the
flag.
end, I
They
know,
hung him
and
from a
ironic.
crane.
I thought it was in the first season.
No, I don't think
Are you
so.
sure? That got a little monotonous. She's freaking
I
crazy,
think
and you know what I
most of
mean,
them
like
do.
all this
Most of
stuff.
those
And
shows get monotonous.
you know why I couldn't watch that show? At a certain point, I got sick of it, and I'll tell you why. Because my wife looks a lot like who's that actress?
Claire Danes.
Claire
Claire
Danes.
Danes.
Yeah.
And every time she's freaking out, like remember she was like
Oh,
bipolar.
You
and I
felt
was
it.
like, is this my wife? You know what I mean? Like,
Yeah.
what's going on? It kind of freaked me out.
By the way, My Wife is a great song off of the Who's Next
My
album.
wife.
My Wife.
Okay,
John-
Jacob, can we get a little?
John
My
Entwistle.
wife.
My wife.
No.
John
My
Entwistle
wife.
sang that song.
I know
John Entwistle, of course, the bass player of the
who
Who
died.
many years ago.
Yeah, back in 2000.
Called him the Ox.
in 2002. You
You
know why I know that?
no, I don't.
Because they were on tour,
And he passed away.
and I went and saw him at MSG. Were you at that show? I
Might
want to
have been.
say in August 2002.
I saw the Who in 1982 at Shea Stadium in October of 82. Shea Stadium.
Yeah.
David Johansen was the first act, got booed off the stage, rightly so. You know who the second act was?
I think you told me, was it The Clash?
Was booed off the stage.
I love
Wow.
One of the most overrated bands of all time. Nobody was there to see the effing Clash. And by the way, it was like misting out, so it was shitty out. And it was like, one of those
You and I are
October
kind
nights.
of like an old married couple because, like, I knew.
So, I mean, it's like-
I knew that
It's like,
story. I
get
knew the other
off.
story.
Nobody
I knew-
is there to
He
see.
says Entwistle.
Nobody is there to see the Clash. Nobody.
Yeah.
And if you're there to see get the F out. And Shea Stadium is a shithole. So all those things together, but it was a great concert. The first song they played, do you know?
No.
Athena.
Oh yeah, I love Athena. I
Athena.
know. I had no idea how much I needed.
Yeah.
Yeah.
In peaceful times, I'd hold her close.
So Guy has a lot of people don't put in their like number 1, 2 slot for best classic rock bands, the Who. They're in there.
Who's up there?
But you got them
no,
up
it's
there.
Zeppelin. Who's up there? I mean, maybe I should put that out on the Twitter again. My top 10 bands.
No
of
one's
all
on the
time.
Twitter
think you should.
anymore.
Nobody's on the Twitter
I'm
anymore.
on the Twitter.
Do you get engagement on the Twitter?
Yeah.
Do you really?
Mhm.
More than
Some of it's still quite rude, but
This little inside baseball stuff.
is Liz
my
getting
my
bored of us?
my playlist, 900 song playlist on Spotify. That's what we use at Fast Money on the set. And some of the songs are like 70s yacht rock, and it drives Dan absolutely batshit crazy.
It is
I love it.
literally
So good.
brutal. It's brutal.
Last night we had some Bee Gees going,
Yeah.
right?
It was horrible.
Dan styled out.
Yeah.
All right, well, listen, I've enjoyed this. Hopefully, Amanda's enjoyed this. As I said, Elizabeth, we hope to see you next week, but if we don't, we know the reason why.
that's right.
There will be a new baby in the world, and we'll all be better for
We're
it.
still working on his name.
Listen, when you see that kid, the name will come to you like,
I hope so.
That.
That's what everybody says,
I'm
and
telling
I
you.
just expect that he's going to look like a baby.
Guy Christopher is a great name, by the way.
Daniel Stevens, also a great name.
We'll see you when we see you Monday. New time for market call, Dan, 11 a.m. You dropped a podcast with Gene Munster.
Yeah, it's
today.
in your favorite podcast store. Go watch that. We broke down the NVIDIA report and we kind of extrapolated a little bit. And then tomorrow morning in the podcast store is going to be Guy, myself, Tom Lee of Fundstrat. Tom Lee of Fundstrat. We're going to record that in about an hour or so.
Wow.
So that'll drop tomorrow morning. So check that out, Liz. Have a great weekend.
Bye, guys.
Bye.